Okay, well, for Michael and Austin, should I give just a little bit of my background then?
Yes, please.
Okay, because so what my role is here is to work on the education side, educating our clients and employees and people that are members of the Hive and whatnot. So I have my master's degree in business, and I was a financial advisor for 18 years. I have my Series 7, 66 insurance, and lived my life in a very regulated, highly regulated industry. It's been around for 90 plus years, so lots of rules and regulations have been, you know, put in place, which is very different than what we're experiencing with crypto. But those regulations will be coming, and our goal in the academy side of it is to educate on investments, and then also to educate on the crypto side, and making sure that we all understand, kind of from a taxation standpoint, from a regulation standpoint, that we're staying compliant and all of that. So what I did the first meeting that I was part of, we talked about 11 ways that you could manage your crypto taxes. Today, Brian asked me to talk about ETFs, or exchange traded funds. So mine is much more basic than what Gabe was just talking about, but I'm going to go ahead and share my screen and get this. Can you see that?
Yeah,
So
we see
ETFs,
we
exchange
see
traded funds.
Right. So what we're going to talk about is exchange traded funds. That's what the topic is today. And I'll try to move through this so that we make sure that we bring everyone along in the conversation, but it's not boring. So what I want to do first of all is I just always start out by making sure that everyone understands that information is not intended to be financial advice or tax advice. It's simply for educational purposes. Okay, so I think the best way to explain ETFs is to break it down into what each of the words are. This is an exchange traded fund. So the exchange part of it is whether you're talking about the New York Stock Exchange, the NASDAQ, the London Stock Exchange, or even the index exchange on the crypto side. The index does actually have its exchange. It is on an exchange. So that's an important thing to include here. And then traded, the whole idea behind the exchange is that once a security or once a stock goes past its IPO, then it goes to what's called the secondary market. So it's basically just a big auction, and that's for people that are wanting to sell stocks to other people that want to buy the stocks or trade. Then that transaction it happens on the exchange. They're able to the stocks sell for what people are willing to pay for it, whether it's overvalued or undervalued. It doesn't matter. It's what they're willing to pay for it. And so what the stocks are doing is being traded on the exchange. So the fund part of it is kind of an interesting thing, and this is describes the nature of the investment. And what I like to do is use cake as an analogy to define what a fund is. So when you make a cake, you take all the ingredients, the butter and sugar and eggs and chocolate, and you add them all together, mix them up, and put them in a pan, and you bake it, and you end up with a cake. It doesn't matter what size of a slice of cake you get. You'll get a proportionate amount of each of the ingredients in each piece of cake. Even if you have one bite, you will still get a piece of each of those ingredients. So the analogy of a slice of cake to a fund, whether it's a a mutual fund, an exchange traded or an index fund, or an exchange traded fund, a hedge fund, it doesn't matter. What the fund manager does is instead of mixing all the ingredients together, they put investments together in a bowl of pooled investments, and these ingredients for the fund are things like stocks or bonds or precious metals or other assets, or things that can invest in from the exchange. And they put their chosen securities together and make the fund. So how much of that fund you want is dependent on how much you can afford or how much of it you want for your portfolio. And then no matter what amount you choose, you get a bit of ownership in each of the holdings in the fund. And the benefit to a fund is that you're able to spread your investments around, so your exposure to any one type of investment is limited. And there are thousands of companies listed on the stock exchange, but if we just talked about the S&P 500, it's made up of the leading 500 US large cap companies, and companies like Apple and Microsoft, Amazon, Nvidia, those kinds of things. So if I listed all 500 of the stocks on the S&P 500, you'd probably recognize 490 of them. But if you said, okay, well, those all sound like really good funds, I want to invest $1,000 in each of those stocks. And I want to invest $1,000 in each of those stocks. You'd have to have $500,000 in order to invest, and then you would have to manage each of those stocks individually. But if you don't have $500,000 and you have $5,000, then you're able to buy $5,000 worth of that fund, and you still own a little bit of each of those holdings. So an ETF, then, the exchange traded fund. So it's a group of stocks that have the benefit of the mutual fund's diversification and the stock market's ability, or the stock's ability to trade on an exchange. Unlike a mutual fund, the mutual fund buys and sells at the fund company. So the mutual fund company, American Funds, Fidelity, whoever, they buy the stocks on the exchange, and then they manage them at their fund, at their company. And so you are buying the fund from the company, but it's a diversified portfolio of stocks. If you buy an individual stock, you go to the exchange, you buy it, and you sell it on the exchange. So that's the main difference between the mutual fund and an exchange traded fund. Does that make sense? Yeah. Okay, so there are some real benefits to having the exchange traded fund as opposed to a mutual fund. So the tradability and accessibility. So like I said, the ETFs provide the benefit of combining the diversification of the mutual fund, meaning you have a whole bunch of different stocks. You're not dependent on any one stock doing well, or if a company goes out of business or they do really poorly, your portfolio is affected less dramatically if you have a variety of holdings. And the mutual fund allows people to do that, and an ETF even gives you more control, because an ETF trades all day long. It can be traded anytime the market is open. So you can follow a mutual fund or an ETF, on the market all day long. You can buy it, sell it whenever you choose. Mutual funds only trade at the end of the day. So those mutual fund managers at the mutual fund company take the list of all the holdings in the mutual fund, add up, so at the end of the day, the market closes and you know what each of those stocks are worth. They add them all up, divide them by the number of shares, and that's what that mutual fund is worth at the end of that day. So if you see a lot of things happening and you just want to get out or you want to get into the market, with mutual funds, you have to wait. You can only do that once a day. ETFs allow you to do that at any time the market's open. The other benefit of the ETFs as opposed to the mutual funds is their expense ratio and how much it costs for the management of those funds. There is some management on the exchange traded fund side, but not nearly as much as the mutual fund side. So it's less expensive to have the exchange traded fund. And also there's a much more tax efficiency with the exchange traded funds, even though all of them, index funds, mutual funds, exchange traded funds, they're all subject to capital gains and the taxation of the dividend income. But the ETFs, they are more, there's less management involved, less buying and selling involved. So you don't have as many people selling out of a mutual fund. With the ETFs, you don't have as much as what it happens with the mutual funds. The mutual fund managers have to sell not necessarily when they want to, but because of when people are selling out of the mutual fund, and then they have to take gains when they maybe don't want to. But so the mutual fund managers are constantly rebalancing and they have to sell in order to do that. So there's more of a capital gain. The other problem you have with a mutual fund that's different than an ETF is that if you buy into the fund when there has been a holding in there for a long time and they have a lot of capital gain on it, and then you buy into it, the mutual fund's value can actually go down. And if you sell it, you have a capital gain embedded in it that you are responsible for. So if it's in a taxable account, a non-IRA or non-401k account, then you will be responsible for the capital gain that's embedded. The other benefit of the ETF is transparency. You can go online at any time and see what the holdings are in the exchange traded fund. They tell you exactly what's in it every minute of every day. You can go online, look at exactly what the holdings are. The mutual fund companies are not quite as transparent. And what this does is it allows you to make more informed decisions about your asset allocation. So you can see what's in the fund. And if you say, gosh, I have a whole bunch of holdings already like that, I need to do something a little more that's going to provide a little more diversification in my portfolio, then you can actually see what's inside the ETF, where the mutual funds are not always as transparent. So right now, the really interesting thing about what's happening with the crypto in the crypto space is that this is a number of companies that are right now waiting for the spot Bitcoin ETF approval. And in the case of BlackRock, in the case of their ETF application, a lot of the excitement is tied to the fact that they are the largest asset manager in the world, and that their involvement and filing on this and the interest in the crypto space has really validated the whole crypto industry. So what I had a kind of a quote here that was from the BlackRock CEO Larry Fink, and he argued that a monetary asset untethered to any national government will become increasingly attractive. So this is a huge thing right here, and the fact that Indexx has an ETF of the cryptocurrencies. So basically what the ETF at Indexx is an exchange traded fund that is, I think, what do you have, the top 20 cryptocurrencies in that fund? Or how many cryptocurrencies are in that fund?
Yeah, there's a few different ones, and after you finish up, I can go through the 5 different ones. Yeah.
Yeah.
I can
You go ahead.
show them. Yeah.